You're watching Inside Automotive with Jim Fitzpatrick.
Good morning, everyone. Jim Fitzpatrick. Thanks so much for tuning in to another edition of Inside Automotive right here at the CBT Automotive Network. After 3 years of decline, dealership profitability is on the rise again, according to Q1 2025 Presidio-NCM average dealership performance benchmark data. Joining us now with more on the data is Keith Stile, who's the COO of Presidio Group and also former CFO of Asbury. So thank you, Keith, so much for joining me on the show today. For the dealers that are watching, refresh our audience. What is the Presidio-NCM average dealership performance benchmark?
Yeah, well, we work closely with NCM. It's an exclusive partnership.
Okay.
And they provide data to us on a quarterly basis for the 4,000 dealers they serve. So this data is a really wide breadth of data, and we get it very timely, Jim, too. That's the important thing here. We released this data last week, Tuesday. Okay. So right ahead of all the publics, actually. Wow. And we're putting some pressure and finding some ways to get that out even sooner to the dealer community.
Wow, that's impressive. I mean, and this is 4,000 dealers. That is a real great sampling, right, of the dealership body that's out there.
Yeah, it's 20-25% of the dealers. Wow. You know, the publics, obviously are our other barometer to check on how the industry's doing, and the publics represent about 8% of retail volume today.
Okay, 8%. You hear so much about the publics. I think people, for the average person out there in the business, they think the publics are dominating the industry, but in reality, it's only 8%, right?
Correct. Yeah, there's a lot of room for additional consolidation in the industry.
Yeah,
still widely held.
That's right. So what do you attribute the rise of dealership profitability to?
Well, I think it's a couple things. First of all, it's the stability of new vehicle gross profit. Okay. That is kind of stabilized, and it's only down 1% sequentially. It's down quite a bit, from compared to last quarter, but only 1% sequentially. Okay. And then really that engine of fixed operations, which is up about 6%. Yeah. So the fixed operations is now, as of 2024, is now making up over 50% of the gross profit of the dealership.
Wow.
And then they did a good job. I mean, dealers broadly, those 4,000 dealers did a really good job. We're seeing some nice movement in the personnel and advertising and even floor plans. So the expense structure held together to deliver that 4% growth in profitability.
Sure. Some lessons learned coming out of COVID, I would imagine, where we can run a dealership maybe on less headcount and less expenses, less marketing and such.
Yeah, well, there's also the inflationary pressure that everybody's gone under. Cars are more expensive than ever. They're up 50% average selling price of a car in the last 10 years. Wow. We don't have to, wages, salaries, everything in a dealership costs more. So that's right. You have to stay disciplined, and there's dealers that stay disciplined on those things.
Yeah, that's great. What stood out to you most on the report?
Well, we talk about 4%, but all brands aren't created equal. So if we start digging down in the data a little bit, we start to realize that there's different trends based on import brands, luxury brands, and domestic brands in those categories. So if you dig back into the quarterly data in 2024, you start to notice that not all these brand segments are experiencing the same thing at the same time. Okay. And the luxury brands hit their low point of gross profit in the third quarter of last year, and that improved in Q4 and Q1. Okay. And now we see that luxury brands profitability is up 18%. The midline imports seem to have bottomed out in Q4. Okay. And their profitability is now up 6%. The domestics are a question mark, and there's a lot. There's a lot of brands in there, but the domestics are a question mark right now. The profitability is down 4 or 5% in the first quarter. Okay. And with that, the gross profit slid as well.
Okay. Any reason behind that it's down?
I think if you listen to Kevin Tynan, who's on our Perspectives team and leads our thought leadership, it's as simple as Econ 101. Okay. It's supply and demand. Okay. So whenever you have a situation where you have oversupplied inventory, there has to be some give and take in that system, and that finds its way into lower gross profit.
Yeah, for sure. What's the biggest takeaway from the report?
Well, when we look into the data, when we study the data over the longer term, there's a couple of things. I'll deal with the first quarter and then some more broad things. Okay. The first quarter, we have to acknowledge there was a little tariff-induced demand. Okay. And when I say that, January, February, flat new unit sales. Right. March, up 15%. Wow. So the market clearly reacted, the consumer clearly reacted to the threat of tariffs and what might be coming of price points of cars increasing in the future. So that's momentary, but it was a real factor that impacted the quarter. Yeah. I think broader themes are, if you look back over the pandemic and what this data is showing us, is that tight supply isn't necessarily bad for dealers. Yeah. We used to think if we don't have cars, we can't sell cars, we can't make a living. Yeah. Well, you look at some of this data, specifically when you look at our average dealership profitability index and where that went during the pandemic. So our dealership profitability index is very similar to the Manheim index for people that are familiar with the industry.
Yeah.
So we benchmarked that to 2019 pre-pandemic profitability and kind of watched how the profitability moved. What was up 300% by 2021, 22.
Wow.
And then that's fallen for 3 years, as you mentioned.
Right.
And now it's leveled out at about 180. So up 180% from 2019. So the dealerships in general are very profitable.
Yeah, that's pretty impressive. Yeah. Hence the reason that the acquisitions are staying as brisk as they are, right? I mean, it's still a good business. People are still wanting to buy dealerships, or I should say dealers are still looking to grow their dealer groups, right?
Yeah, I mean, there's been a lot of large acquisitions on the public front. There's been a lot of consolidation in the private sector as well. All of that has led to really great cash flow during the pandemic. The balance sheets are stronger than they've ever been.
Yeah.
And we're seeing increased activity as this year goes along.
Yeah, that's fantastic. And I would imagine you've got a pretty robust pipeline.
We do. There was a little pause in activity closings in the first quarter here across the industry. And that was really, if you go back a quarter, that was the uncertainty around the presidential election and lack of deal making during that time, which led to less closings. But that has totally course corrected. We're expecting a very robust 2025.
Okay, great. And in terms of some of these vehicle numbers that I'm looking at the report right now, gross profit on new vehicle down 20%. That was kind of to be expected, though, right?
Absolutely.
I mean, those numbers were because we're looking at the high water mark during COVID, and everything's been coming down.
Yeah, the important point on that is yes, down quarter over quarter 20%, but stable from the fourth quarter, relatively stable. Okay. Once again, down for domestics, but stable for the industry.
Right. And then gross profit per used vehicle retailed up 1.3% to $1,400.
Yeah, that's a pretty good job on used vehicles. Obviously, the first quarter is a really good time, especially as we head into March. It's a really good time for used vehicles.
Tax refunds.
That's correct.
Yeah.
You know, we do believe that the used vehicle environment will be difficult going forwards, largely because of the off-lease situation. So if you go back to 2018 to 22, the industry had about 5 million vehicles coming into the market off-lease. Right. Well, we forecast that this year that could be as low as 2.5 million. So it's really going to be a fight for inventory.
And you combine that with consumers that are thinking, well, maybe I'll buy a CPO or a used vehicle versus dealing with the tariff situation. That puts that much more pressure on used vehicles as well, right?
Yeah, the future probably is all prices are going up, whether they're used or new. Right.
And as we saw during COVID, a similar situation with the used vehicle market as well, when you had the chip shortage and what have you. It got to the point where some of my friends that were shopping for a vehicle would call me and say, are you aware that the price of a new car and the price of a 3-year-old, late model vehicle is almost the same? And how could that be? It's like, well, that's the market that we're in. There's just a shortage of new cars, and therefore it applies that much more value on all of the used cars that are out there.
Yeah, that's right. And that very well could be the environment we have until this corrects a little bit in the coming years.
Sure. Dale Pollack, I remember back then, said your vehicles is the first time in history where a used car department and the vehicles that are on that lot are actually appreciated in value. Never before done, right?
Yeah, that is so true. There's an old adage that, used vehicles are a garden of vegetables and they don't get better by the day. Eventually they get worse.
That's right.
But in this case, they got better by the day during the pandemic.
It was crazy. Yeah. And you think we'll see more of that?
We very well could be stabilizing at a higher level.
Yeah, that's right. Talk to me about the impact that this tariff situation has had on the M&A market out there.
We see dealers really looking through it, honestly. I think they understand their businesses very well.
Right.
They're professional portfolio managers. They know the assets they want to go after.
Right.
So we see when there's attractive assets that are open in the market, we see dealers moving very briskly.
That's good. And I think as Senator Bernie Moreno said a couple of weeks ago at the New York Auto Forum, and he said, this is a blip on the radar, and that we're going to look back at this in a year and we're going to have a good chuckle over it. Do you agree with that statement?
Listen, there's one thing I know from this industry, being involved with it for 25 years or so. The entrepreneurial spirit. Never undermine
That's right.
or discount the entrepreneurial spirit of the dealer body.
That's right.
They always figure it out.
Yeah,
And
for
I
sure.
think this will be the same case.
Yeah, I agree. I agree. In terms of hot dealerships, while I got you here, because I know that since you're with Presidio Group, I know dealers would say, Jim, you'd be remiss if you didn't ask. What are some of the hot franchises out there that dealers want these days?
Yeah, on the luxury side, despite the tariff situation, on the luxury side, we still see very high demand from Mercedes-Benz.
Okay.
Probably some of the highest level demand.
Okay.
And brands like Subaru, which
Yeah.
kind of surprised us last year, coming up in our top 5, our top
Yeah.
7.
Yeah.
And
Wow.
so there's a lot of demand for that brand as well.
Yeah, and that's interesting. I mean, it's got such a loyal following and loyal customer base for sure. And yeah, I would agree with you. To have Subaru in that top 5 is amazing. But you still got these other big brands out there that everybody wants, right? The Porsches of the world and
Porsches is highly valued. Toyota,
Yeah,
the loyalty
still.
of that customer base highly valued.
Yep.
So there's still great assets to be had.
for sure. And you think we'll see a lot of activity from the Publix in 2025?
Their balance sheets are very well positioned. They've all showed a propensity for acquisition.
Right.
I think there's 1 or 2 that have maybe put a little pause on that, but they're generally speaking, we see a very proactive, aggressive stance on acquisition, and I think that'll continue. As they've grown these companies, they've grown greater cash flow, they've grown their balance sheets, they've grown their lines,
Right.
and their ability to borrow.
Yeah.
So it's just created a bigger and bigger engine to fuel acquisitions.
Sure. And a couple of them have gotten into the used car business in a very big way, like Sonic Automotive Group with Echo Park, and then you've got others, AutoNation with AutoNation USA and their stores and what have you, which in the situation that we're in right now where used cars are in such demand, they should do very well with those outlets, right?
They should. It comes down to inventory, right? It still comes down to inventory acquisition. So those that can do a good job at buying cars off the street, not just relying on trades or off-lease vehicles, they'll have to fuel that inventory in some other way.
That's right. Every dealer I talk to has got a strong effort going on in their stores to acquire cars right out of the service lane. Everybody gets an appraisal and gets a follow-up phone call to say, we're in high demand of your particular vehicle. Are you interested in selling it? And it's become quite a great resource for used vehicles.
Yeah, it's a very prudent approach. I mean, you have the customer in the dealership, you know the car, you have the service record of the car, you know the history of the vehicle.
Sure.
It's a very easy way to put a number on a car.
That's right.
And bring it back into inventory.
Yeah, yeah. I had Kevin Tynan from your company here a couple of weeks back, and he reminded me when I said the impact of the tariffs on the industry, and he said, yeah, we might sell less cars. Maybe the SAR isn't 16.8 or what have you, but at the end of the day, keep in mind that in 2022, I believe he said, it was a high watermark in terms of profitability for dealers. The SAR was 13.3 million vehicles. So we sold, 4.5 million less vehicles, and dealers made a whole lot of money in doing that.
Yeah, Kevin's coined it, what could potentially happen is the tariff pandemic.
The pandemic,
so
right.
It's taking the two and putting them together.
Right.
But some of the things we've learned about having tight supply, we expect to happen.
Sure.
It might be in fits and starts, it might be for certain brands, but we
Right.
do expect some of that to happen.
Right, right. Overall, what's your take on the year ahead in terms of the overall business? Think we'll be okay, or?
Yeah, I think it'll be a good year.
Yeah.
I think we'll settle down. The political environment will settle down. The tariff environment will settle down. We're keeping a close eye on the consumer and the consumer's balance sheet and the consumer's ability to handle higher price vehicles.
Right.
So that we'll keep a close eye on.
Yeah.
But the business itself is very versatile,
Yeah.
and we expect. I would expect the dealer body to continue to stay focused on that fixed operations. And
Yeah.
there's a couple areas that we think are that just have such potential. And we talk about limitations in fixed ops from technicians, we talk about service bay capacity,
Yep.
but we think there's now some green shoots around mobile service and doing that in a profitable way. And then you probably know this as well as I do, but the amount of open recalls on our roads today are phenomenal.
Unbelievable.
70 million
That's right.
vehicles,
That's
25% of
Yep.
the US fleet has an open recall.
Yeah.
That service revenue is worth about $50 billion, some estimate.
Sure.
And that's just a massive opportunity that we
is.
have to unlock as an industry.
There's no question about it. There's millions of dollars to be made in open recalls. It's just unheard of, but incredible. So Keith Stiles, COO of the Presidio Group, thank you so much for stopping by CBT News. I know our dealer viewers will get a lot out of your visit, so thanks so much.
Great, thanks, Jim.
Thanks.
Thanks for watching Inside Automotive with Jim Fitzpatrick.